Thanks, Kyle, and thank you very much, everyone, for sticking with us. I know the graveyard shift is a bit tough, but I promise to make it entertaining. Brief recap on Plato. Plato, we're turning 20 next year, and we've just gone through 20 billion, so a big year for the firm. Plato Global Alpha, the fund that I'll talk about today, has just gone through 1 billion. So what is that strategy? It's a global equities turnkey core solution. The performance has been really strong, as Kyle mentioned. We've done 24% return annualized after all fees since inception. That's outperformed the MSCI World by some 12%. Now, the distinctive part of this strategy is it's a 150-50 strategy. Many of you would have seen 130-30 strategies over the years. So this is 150-50. So for every $100 a client gives us, we've got $150 to invest in the most attractive ideas anywhere in the world. That supercharges the alpha that we can generate for you. But we've also got this 50% short component. Now, many managers in Australia, and I'm not sure exactly why, they seem to have struggled to consistently add alpha on the short side. It's actually been our most valuable source of returns. We've outperformed the market by over 12% a year. The majority of that has actually come on the short side, and I'll go into a little bit of detail later on exactly how we make that happen. A huge focus at Plato is to deliver what we refer to as all-weather performance, okay? Now, in reality, nothing's really all-weather. There's always going to be environments that are more challenging, but it's really our North Star. We're trying to create a smooth return profile both for you and for your clients. The longer I've been managing money, the more and more I'm just totally convinced that clients will often come to us and say, Dave, I want something that's really high return, I can take high risk. But when they actually live through that experience of what high risk really feels like, that protracted drawdown, as often as not, they'll panic, and as often as not, they'll capitulate at the worst possible time. So providing a smooth journey for investors is absolutely critical, and that's exemplified in that downside capture we have there of 65%. As they say, a picture's worth 1,000 words. So what we have here is the cumulative outperformance of the Plato Global Alpha strategy since inception. And you can see it's that bold line up the top. Very, very smooth performance trajectory. Those faded lines beneath, they're the 40 largest peers. Some phenomenal fund managers in that list, but they tend to be much more concentrated and far more volatile, as you can see. An analogy that we sometimes use here, and some of you may have heard me mention it before, greatest batsman of all time, Don Bradman, average of 99.97, only hit 6 sixes in his entire test match career. His whole philosophy, very different from everybody else. Just hit the ball along the ground, don't try and go for the big kill. That's very much what we're trying to do, work the singles every day and just eke out that little bit of alpha every day, every week, and every month. A very fair question would be, say, this strategy where we're just getting to our 4th anniversary, how repeatable is this over the long term? And do you know what? We're not going to keep doing 12.5% alpha, okay? You know, I'd love to say that we could do that into the long term, but markets just aren't that easy, as we know. As Kyle mentioned, I was at JP Morgan for 15 years. I was head of research there. I was running long-short strategies, long-only strategies, and the key long-short strategy I was running was Europe Equity Plus, 130-30 strategy. We generated 4% net alpha over a decade. We took the fund from 30 million seed to 5 billion euros. And this green line here is the cumulative outperformance. Again, very smooth performance over time. It's a very repeatable process that we've built. So how do we actually make that happen? Well, one of the key tenets of the approach is to be very balanced across investment styles. And I think it's why many managers struggle to have persistent outperformance. If you're extreme value or extreme growth, as the style winds blow the other way, you can easily come under a lot of pressure. So we'll always look to have the best value, the best growth, and the best quality companies we can find anywhere in the world. So look at JP Morgan, arguably the best run bank in the world. There's 30% higher net interest margins than our beloved CBA, trades at just 15 times earnings compared to CBA at 30 odd. BYD, we really like BYD relative to a name like Tesla. So BYD's growing rapidly. They just overtook Tesla as the best-selling EV company in the world. 50% higher free cash flow, 90% lower valuation, and they have a CEO who's not so polarizing. Quality examples, always good to have some quality companies in the portfolio to really give you that counterweight when things get rough. Nothing is defensive as defense, as the old investing adage says. Rolls-Royce, this is a name that's massively benefited from the real Trump trade. Everyone said the Trump trade was US onshoring. The real Trump trade has been European defense, as the European countries have been forced to increase their spend from less than their 2% NATO obligations to almost 3.5%, 5% of GDP. That's been a huge catalyst for names like Rolls-Royce, which is up over 5%, 500% since we bought it a couple of years back. You put those building blocks together, best of value, best of growth, best of quality. If we get it right, this is what it's going to look like. This is the historic monthly outperformance over and above the MSCI World each period. And you can see the first 18 months of the fund's life, it was a value market. It was also a bear market. We were consistently outperforming. Then all of a sudden, there's a technological shift. There's AI, large language models, data centers. And you can see the portfolio didn't miss a beat. We continued to perform very well in that new bull and growth market. Then you can see here, this blue line here is March, okay? And you can see that that was a huge value month. You might recall that growth really fell out of bed, got crushed. We had our equal best month ever. So as far as possible, we don't want to be tied to the fortunes of what value growth style is in favor at any one point. One part of the Plato approach that is a huge part of the edge that we have is 150 red flags, fully systematized, so we can bring up any company in the world and instantly see what risk factors that they have. Okay, these span corporate governance, forensic accounting, signs of balance sheet stress, executive misconduct, and so forth. The magic critical number really seems to be 8 or more red flags, and we've never seen another manager systematize this anywhere in the world. If a company has 8 or more red flags, our research shows that over the next 12 months, on average, it will underperform the market by 20%. It's the most powerful single way we've ever devised for really doing two things. On the long side, avoiding landmines like SETA that may look fantastic that you just don't want to touch. Okay, Opthia is another example. 18 red flags. That was a name we never would have touched. And equally on the short side, this is a huge driver of the tremendous short alpha that we've been able to generate. If you look at here, we can see the cumulative contribution of the longs and the shorts in red, and you can see that the shorts have actually contributed most of the alpha in the fund to date. So it's really important second alpha engine that we have driven by those 150 red flags. One point that really, I think, is a key Plato edge is our attention to risk management. The vast majority of fund managers that I'm friends with, they spend almost all of their time on deep stock research, and there's absolutely nothing wrong with that. That's a prerequisite for success. But if you don't marry that up with a very well-reasoned risk management process, you can easily turn what could have been a great result into a disappointing one. So how do we put that into practice? We spend about a third of our time on that risk management piece. On the right-hand side here, this is Plato's proprietary risk management system. We look at 96 different stress tests on our portfolio every single day. Just as a bank will stress test their mortgage book, we'll stress test the alpha on our portfolios. What if there's a big tariff shock? What if there's contagion in US regional banks, collapse in Chinese property, an unexpected OPEC decision or election result? We quantify it and then we look to manage that risk, because the reality is it's fascinating to talk about all those geopolitical, thematic, macro events, but so hard to get right. You get 10 economists in a room and ask them their opinion when inflation's going to peak, you get 20 different opinions. So very challenging to get that right. So we don't take much risk along those dimensions, and it allows us to stick to the one thing that we are good at, picking outstanding companies on the long side and very challenged companies on the short side. That's translated to outstanding performance, great downside capture. What you normally see, funds that have a very low downside capture like this, that are preserving capital when markets sell off, they usually give up the upside, right? We actually see our upside capture is 127%. So not only are we preserving capital better on the long side, we're actually doing better on the upside as well. Plato Global Alpha available through all the standard platforms, obviously Zenith and Lonsec recommended. We launched an ETF, active ETF of this just at the end of November last year. There's already about 250 million in that, so that's proved tremendously popular with clients. Doesn't trade at discounts or premiums, just trades essentially in line with the underlying unit trust. We also have some phenomenal income funds. So if this doesn't take your fancy, we have market-leading Australian income funds. It's generated 9% income since inception, some outstanding global funds as well in the income space. So please reach out. Thanks for your attention today and look forward to having a few beers with you later on.